Yo, 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 what's up? What's up? Sandra B, what's up, sis?
What's good, Dennis? Everything's good over here.
Look, man, I'm excited. I'm excited for today's episode because we are going to talk about something that is so taboo in this industry. It's crazy, right? Because it's been a part of the industry for some years now. It's not a new concept, and it's actually been working for people. But hey, when you bring it up, man, I mean, it's I'm telling you, man, it's like people start getting out
Emotions.
witch doctors, everything. You know what I mean? Oh no, they start pleading the blood, throwing holy oil on you and everything, right? Because he's supposed to be talking about it. So
Right.
it's crazy. You know what I mean? So I mean, tell them a little bit about what we're gonna get into tonight.
Man, tonight, y'all, we're gonna go ahead and dig like deep into these IULs, which is better known as Index Universal Life Policies. I know you've probably heard about it, may have not looked into it, because a lot of people think it's some, I don't know, like a magic school bus type thing. They don't really work, or it's a fairy tale, but it's very real. I have one. I have a couple of them. My kids got one. I'm sure Dennis got one. It's a great vehicle to really set yourself up while you're alive and even after you're dead. So, we're going to get into it all tonight.
Absolutely, guys. As y'all see right there, again, the ultimate millennial money hack, right? Should an IUL be a part of your financial portfolio? I mean, hey, but look, you got to stick around in order to know if it actually should be a part of your financial portfolio. I know Sandra says she got one, but should she have one? Should I have one? We don't. Should our kids have one? Should you have one? We don't know, but we're gonna definitely talk about it, guys. But as y'all already know, when it comes to drill for skill, man, we got to let y'all know again every first and third Monday of each month. Today is April Fool's Day, first Monday of April, and so we are here today with y'all. And then next time you will see us both will be the third month of April. All right, guys. And as you see right there, man, hey, we go over a gambit of different things. Mindset, right? We talk about, a lot of things that has to do with the insurance business, right? Being a broker, right? Being able to help guide people into the right direction, whether you're coming into the business or whether you want to find out some information on, a certain product and how it can help work for you and your family, right? To better protect you all in your future. So, guys, without further delay, we always start off with a mindset video. All right, guys. So we are going to get into this, man. This is talking about the 4 levels of value, right? You definitely want to get your paper and pen out for this one. It's by none other than Mr. Myron Golden, who's going to be dropping some amazing information on the 4 levels of value, guys, and how this can apply not just to this business, but just life in general. Okay, so here we go.
Make a lot of money, make a lot of money. There's a reason people who make a little money make a little money. And it's because income is the result of value created and offered in the marketplace, right? So value is what creates income. And there are 4 levels of value. And if you're operating on one of the lower levels, you can only make so much money, right? And I'll just tell you what the 4 levels of value are, so you can kind of wrap your mind around. There are 4 levels, but there are 5 resources. The top level of value, you have 2 resources you can use. So every level has 1 resource, but the top level has 2 resources. So the lowest level of value is implementation. That's the lowest level of value. That is the people who do the thing. So if you do the thing, you're the person who does the thing, you make the least amount of money. And I basically tell people in the presentation, if you're an implementer, I know how much money you make. You make somewhere between minimum wage and $80,000 a year. You make minimum wage if you're like working as housekeeping staff at a hotel or McDonald's or whatever. You make $80,000 a year if you're like a mechanic that works on Rolls Royces or Bentleys or something, right? So that's your income window. And then the next level of value, and by the way, the resource that you use at that level is your muscles. You use your muscles to make money. By the way, I shouldn't show that on camera, but it's here to protect you, not to harm you. Anyway, Pardon my corny. I'm a corny dude. What can I say? So, the resource, you use your muscles to make money. And the whole premise of the concept is that money is spiritual in nature. It is not materialistic in nature, right? And so if you're using a physical resource like your muscles to make money, then your income is going to be limited. If you want to make more money, you have to operate at a higher spiritual value, a higher spiritual level. Does that make sense so far? Okay. So the next level of value, which is the second to the lowest.
The two resources there were muscle, and what was the other resource?
No, there's only one resource at that level.
Gotcha.
That's your muscle. Right. The top level has multiple resources. The bottom levels only have one.
Okay.
Does that make sense? Okay. So the lowest level is implementation. The second to the lowest level is called unification. That is, you use the resources, your management skills. You use your management skills to make money. And you don't do the thing, but you manage the people who do the thing. And so you make more money than the people who do the thing, but you still have a limited income. You're going to make somewhere on the low end between $40,000 a year, on the high end, $250,000, $40,000 if you're a manager at Taco Bell, high end, $250,000, you're a middle manager, vice president, something at Lockheed Martin, let's say. Okay, so that's your income window. You want to make more money than that, like working harder in the same level doesn't make you more money, right? So the next level is called communication. It's the second to the highest level of value. Communicators are some of the highest paid people in the world. I'm not talking about people who communicate a message from their head to somebody else's head, but people who communicate a message from their heart to somebody else's heart. They use their words to make people feel something. You know exactly what that looks like because you do it all the time, right? So you're communicating a message. When you use your mouth to make money, on the low end, you're gonna make 100 grand. On the high end, you might make 100 million. Low end, 100 grand. Cars, you sell cars, you make $100,000 a year. High end, 100 million. You're an actor, you're an A-list actor. You might make $100 million a year. You're Robert Downey Jr., you're a Denzel Washington, you're an A-list actor, you're a singer, you're an A-list singer, you produce albums, you're a Jay-Z, you're an Usher, you are a Beyonce, you're a communicator, you're either an author, you're a speaker, you're an actor, you're a songwriter, you're a playwright, you're a salesperson. You launch this business called ClickFunnels, even though you don't know how to program, but you know how to communicate the message. Hashtag just say it. Okay.
Hashtag.
So hashtag just say it. So communication is the second highest level of value. And people who get really good at communicating can make a lot of money. People who resist communicating, and if I might quote a friend of mine who lives out in Boise, Idaho, they just hate money, right? So communication is the second highest level of value, and you use your mouth to make money. That's the resource. You use your mouth. And it almost doesn't even seem fair, because fair is not a real concept. It doesn't seem fair that people who talk make more money than people who move things and hammer nails and dig holes, but they do. I had these guys come out here and look at my roof today. The guy told me he's been working for this roofing company for 40-something years, and his skin was all leathery, and he had like sores on his head, and I was like, oh my goodness, it's so painful. He uses his muscle to make money, and he's been doing it for 40 years. Anyway, so just thought about that just now. It's like sometimes people will be physically diligent so they can maintain a state of mental laziness. Right? So they won't work hard at learning a new thing, but they'll work hard at doing what's already not working. So anyway, so that's the kind of the progression I'm taking people through, right? And the highest level of value, are you ready? Drum roll, please.
Excited.
Okay, highest level of value is imagination. You use your mind to make money. That's one of the resources, use your mind. The other resource you use with your imagination to make money is money. So those are the two resources you use your mind to make money with. Like, are there people who make money trading stocks and options and commodities and all that stuff? Are there people who do that?
Yep.
Absolutely. Right? Well, are there people who lose money doing the same thing?
Yeah.
What's the difference? The difference is how they use their mind. So your mind is your greatest resource for creating wealth. But most people, we've been programmed our whole life not to think, right? And most people don't think they think. So they just think they think. So what they really do is they're really regurgitating pre-programmed responses that were programmed to them while they were plugged into the matrix, and they think they're having a thought. And so Mind Over Money Mastery is a program where I teach you how to use the three highest level resources and the two highest levels of value. I teach you how to use your mouth mastery. I teach you mind mastery, and I teach you money mastery. That's why it's called Mind Over Money Mastery. So that's the, thank you.
Yeah.
That was real talk right there.
That was crazy. That was crazy. So Sanj, I mean, what was your thoughts on what Mr. Golden shared with us about the 4 levels of value?
Well, the fourth one was a surprise. I mean, because once he got to the third one, it was like, communication. I'm like, well, Dad, what else, could it be? I'm like, and so, he said imagination, mind, and money. I was like, that's real talk. Like that's the top, but it's still, look, y'all, this is like live. My sinuses or allergies has been kicking my tail today. So y'all gonna hear me sniffling. I might have to mute and sneeze, but hey, I'm gonna push through. But yeah, so yeah, I like that. I mean, it makes sense because at the end of the day, shoot, money, mind over money all day. When you can, creators, they make more money than somebody that's talking about something else that somebody else did. So it makes a lot of sense. What was that second one?
The second one was unification.
Is what?
Unification.
Unification. Okay, I didn't understand what he was. I was like, okay.
Yeah, that was good, right? Unification. Right. So unification is you manage the job. So basically, unify. You manage the people. It's pretty much unifying, bringing people
right,
together, stuff like that. Right. Yeah.
So do you think that's kind of like hand in hand with like having a system on it, like in that sense?
Yeah, I guess yeah, you can say that because you have to manage the system. So, like, let's say if you're bringing people into your business, no matter what business you have, there has to be a system. There has to be a path that people follow. There has to be steps that people have to follow. I don't care if it's McDonald's. Okay, if you come in, right, this is how we cook the burger. This is how the chain of all of that works.
Right,
like this. You flip. You cook the burger at this degree. We preheat it to here. And then you cook it for this long. All right. Then you pass it on down the chain. And then now they're going to put the cheese on it. And they're going to put the onions. And they're going to put the pickles. And you squirt this much ketchup. So, you know what I mean? So there's always a system to it. Yeah. But a manager, since we're talking about it, I mean, a manager, yeah, they can manage the system. But even like the person, even like he said in the video, at max at minimum you're talking about an income between 40 to 250K.
Yeah.
Which is interesting because, like he said, at a high level, because again, you're still within that same system,
right?
You're just managing it, right? And then what I also like too was that he said money is spiritual. Is spiritual in nature, not physical in nature. So you have to raise it. So he was talking about if you're going to make more money, you got to raise your level of spirituality. You got to raise, and I believe when we talk about spirituality, right? Hey, look, I'm a believer in Christ, right?
Yeah,
absolutely. And so one thing about our faith and who we affirm with talks a lot about belief, right? Mm-hmm. If you believe in your heart, you confess with your mouth, but the first thing is that you have to believe in your heart before we have an outward confession of what it is that of you saying Jesus Christ your Lord and Savior, right? So you got to believe first. So everything starts within. So it's my spirituality or how I'm thinking, looking and thinking about money has to change because there's a lot of things that happened back in the day before we were even born. Oh, money's the devil. You can't, make this much amount of money. Well, look, you tell me 1 cent right underneath what I can make before because you know what I'm saying? Because hey, look, money solving for all problems, man, and that's in Ecclesiastes, right? And I'm just saying, I'm not saying that to say that you lust after money, right? Because you don't want to lust after money, right? Anything that becomes your God before God is an idol, and we don't want to. I'm not preaching that, but it's a spiritual thing. And I was like, man, money is a spiritual in nature, not physical in nature, Right. Implementation, people who are actually doing the work, which makes sense. If you're actually doing the work, you're not making the most money.
No, you're not.
You're just not more than the person who's managing the person who's doing the work, not more than the person who communicated how this is going to work and all this run, and not more than the person who imagined it. I mean, think about the Ray Krocs, the Steve Jobs, the Walt Disneys. You know,
They had no idea.
The imagination.
That's
You know,
right.
another powerful thing he said too is your mind is your greatest resource to create wealth.
Right.
Wow.
It is.
Your mind is now. I mean, what do you think about that? Like, what, you know, as far as like your mind being the greatest resource, because we think money and all these other different things. Like, why would you think it's your mind?
Perfect example. I mean, you have rich people that are rich one year and broke the next year because they're not doing the right things with the money,
Right.
which is the mindset. So before anything becomes the action, and I forgot, it was like you probably know it, and I can't think of it right now, but it's like your thoughts turn into your actions turn into something. It goes all the way up to your character. You know what I'm talking
Okay,
about?
yeah, your thoughts goes with your beliefs, and your beliefs turn into your actions, and your actions bring about the results.
Yeah, something about action turning into habits. Yeah, it's about, but you know what I'm talking about.
Yeah,
But
T-ball.
everything starts with your mind. I mean, because if you can't think if you don't know what to do, nothing else tells you what to do but your mind. I mean, your mind tells your hands to do this. I mean, however you want to put it, it all starts with your mind. And so that's why knowledge is definitely power, because you have to know what it is to do. You have to implement that thought and put it into action. So it starts with the mind. Yeah, I mean, that's straightforward to me.
No, absolutely. Yeah. You're 1,000% correct. You know, even the Bible says, "So the man thinketh, so he is."
So
You know,
right.
and if your mind isn't, and one thing my father always used to say to us, he say, Junior, where your heart is, that is where you will maximize.
That's right.
And that's something that we all have to take inventory and look and inspect and be like, okay, well, if I'm not at my goals, income wise or spiritual, family, whatever, where's my mindset on everything? Where's my heart at? Where am I actually maximizing, you know, these things at? You know what I'm saying? To really get to that point. So, yeah, I mean, spiritual, everything is spiritual. I mean, hey, look, whether you believe in God or not, you know, your belief in your faith system really makes a difference.
Yeah.
You know what I'm saying? It just makes a difference, man. In all the ways that we move, really actually believing that what you're doing actually is going to work, or really manifesting these things into fruition. You know, I mean, how many times have you thought of something and then either days later, months later, year later, whatever, it's like, I got it. It came
I mean, I thought I was gonna be a millionaire by the time I was 30.
right.
I'm 39 and I'm like, okay, I got it.
Right.
You know, like, it's clicking. I'll be a millionaire soon. But it didn't happen when I thought, because I did not have the resource. Well, I won't say I didn't have the resources. My mindset was not there to think about using the resources to get me where I wanted to be. All I knew is what I wanted, but not how to get there. So yeah, definitely. I thought I was gonna do a lot of things by the time I was 30.
Hey, we all did. You know,
right.
we told.
Better late than never.
Look, always better late than never. Hey, look, if you would have told me, man, I would have been some sort of neo soul artist or whatever. You know what I mean? Doing something. You know what I'm saying? Call myself J Soul back in the day. Wow. Anyway, moving on. So look, let's dive into the topic of the night for these people. So look, IULs, right? Right? What's the hype around IULs? Like, why is IUL such a thing? What's the thing about IULs? And everybody on social media is talking about it, right? So what's making people so interested in IULs now? Because before, like I said again, it's been so taboo. I don't want to do this, I don't want to do that, I don't want to check into it, it's trash, it works like this. What is the hype around IULs?
There's different information being planted into people's minds, which again goes back to the thoughts. And now it got people wondering. And so everybody wants to know, how does it work? Do it really work? Some people say this, some people say that. And it really all boils down to getting it set up the right way, you know? And so that's what we're going to talk about tonight, the pros and cons. There's pros and cons to everything. And when something is done correctly, it can be the best vehicle for you. If it's not done correctly, it's not. If you're not able to fund it properly, it's not going to do what you want it to do. I mean, you know, a lot of people want to be a millionaire, but they don't want to put $500 a month away, you know, so you have to be willing to do the necessary. And all of those things combined, along with talking to an experienced expert in these products to structure it properly according to what your goals are, not to what their goals are, you know. So it's all about making it work for the client, which is what we do best, you know. But you know, we ain't here to sell you on that. We're gonna just share the facts.
They won't share the facts. Matter of fact, if you don't mind, you know what? This is impromptu, right? So look, I'm gonna share a video that I remix that can give you one of the hypes around IULs, right? And then we'll kind of talk about it that second a little bit.
Okay.
I want to show you one of these videos, right, that I remixed, man. And you know, I think I got up to about over 70,000 views on the joint.
Oh wow!
So I'm gonna show you what you know. What's the hype, right? Because is what he's saying real? Is it not? Me and Sandra B, we're gonna dissect it, right? So I'm gonna share this with y'all right now.
From Escape talked about how she put her money inside life insurance. Watch this.
A life insurance policy, you have something to leave for your family, but you're also, it's an investment policy. So as you're putting money in it, it's building wealth, and you can, well, some of those policies you can pull out money tax-free later on.
I was like, I think y'all need like $250,000 a year. That'd be good. And it's like, okay. So they told me how much money I need to put in it a year to be able to take out $250,000 a year, starting at 40 until I would be 99, 250,000 tax-free.
So let's say she did $2,000 a month at 18 years old when she was in the industry, all the way to 37, and she stops. Well, then watch this. The money is growing millions of dollars. And let's say she wants to retire, she'll have around $3.5 million at age 60. She'll be able to take out $217,000 a year for the rest of her life. For the rest of her life, $217,000, which is a total of $5.5 million paid out to her lifetime income. And then when she passes away, family gets millions.
So for more information, so famous.
So look, y'all see, y'all see how hype I was right now. I'm just saying, we're gonna still talk about it, right? And I was looking kind of good too. Skin was looking kind of smooth. But anyway, so look, that video, right? Is that something that really gets people excited about it? But why though?
I think a lot of people hear the end of it, you know. I know, you know, in our community, you know, I mean, we're African Americans, and it's a lot of people in our community that never was left anything. Like that was you know, I shared a video about that as well. I even used Candy's video too, because it, like I said, it went viral. But they were saying that it's hard for us to imagine that because we've never witnessed that type of wealth being passed down to in our families or in our, you know, it's not tangible for us. So again, we only know what we have experienced, unfortunately, which is another mindset thing, because people say poverty is a mindset. It's not like a real thing. So with what they hear out of that video is, okay, they see this young African-American female and she's testifying to what she did with her money. That in that actual, the first part of the video that you showed, the longer part, she was saying how she had more money than most of her friends when she was younger, but they spent their money in buying the fancy cars. She said she lived in a regular house. Instead of putting her money into these materialistic things, she was putting that money into her cash value life insurance policy or her IUL, because she could see that when she gets, you know, years down the line, she can have this tax-free money. And so her mindset was, you tell me what I need to do and I'm gonna do it. And then she said her and her husband now are currently teaching their girls to do this because they're like young adults. I think they're like 18, 19, 20, something like that. but you know, teaching them to do the same thing. And that's the disconnect. Like for this to be a legacy thing and build generational wealth, you don't just have to do it. You have to teach your children to do it. Your children have to teach their children to do it. Else it's only going to last for a few years. I mean, it's still better than what we got left, you know, or what you may have got left when your parents or grandparents died. But we want to break that curse, you know, and do something different. And that's one person that can vouch for it being done, you know?
Yeah, you know, you said a couple of that was a great take. And I think you said a couple of powerful things in there. We haven't really seen anybody in our community with that, you know, amassing that type of wealth and doing that with their money, right? Yeah, of course, we've seen entertainers, singers, songwriters, athletes, right? You know, but there aren't like a huge amount of doctors, aren't a huge amount of lawyers that we've seen in our communities, or people that that's tangible. Like we can actually literally touch these people. And we see that they're doing it. Most of the time that happens in our community, man, if they're doing that, man, they ain't really letting you in on the information.
Right.
Why? I don't know. I mean, it really should be each one teach one, you know. So that was a powerful thing that you said, you know, especially we don't really see that type of money flow happening in our community. You know, we're not growing up like that. You know what I'm saying? Where people are leaving large lump sums of insurance policies, $300,000, $400,000, $500,000, $600,000, $1 million, $10 million to their loved ones and saying, hey, look, you know what I'm saying? I died, but I'm going to give you the chance to start your business. I'm going to give you the chance to really cement your legacy. You know what I'm saying? We don't, you know, there isn't anyone where, you know, like the book says, what would the Rockefellers do, right? This book right here. You know what I'm saying? There isn't many people of color, you know, in that with that type of book. You know, talking about setting up, you know, what they call the family office, then having a board of directors from the family, you know what I'm saying, being able to help people within the family start businesses, get real estate, you know, do investments, go to college, higher education, you know what I'm saying, weddings, whatever it is, you know what I'm saying, being able to put people on the right path. We just don't see it. Then another powerful thing you really said there, and I hope people really caught this, the information being passed down. It's not about generational wealth, about money. It's about what are you passing down? How does it work? What should we be doing? You know, why do we have an accountant? Why do we have an investment guy? Why do we have a financial advisor? Why do we have somebody who does our insurance? Why do we have a trustee? You know what I'm saying? Why do we have these things? Because they say the second generation, 70% of the time, the second generation gets a hold of the money, they mess it up. They mess up the bag. And then they say the third generation, if it gets to the third generation, 90% of the time, they're going to mess up the bag. And you know why? Is exactly what you said was the information. The information isn't being passed down. I tell you why people are hyped. They're hyped because it sounds like the Magic School Bus, like you said. That's exactly what it sounds like when I'm talking to my clients. Like, oh yeah, man, you know what I'm saying? I'm about to put in this money. You know what I'm saying? And I'm like, you know, okay, but this is how it's structured. And like you said, it has to be structured properly. And in our industry, well, let me go back to the Magic School Bus. You know, my mind just be running. So the Magic School Bus, right? So when they hear stuff like that, they see Candace. Okay, cool. Like he said, if Candace was putting in $2,000 a month, which is $24,000 per year from age 18 to age 37, 38, right? She funded it up front for about 20 years. And then the money continued to build until age what? 65. And it was going to pay her from age what? 65 or age 40 or whatever it is.
40 until she was 99.
Until she was 99 years of age. But think about that. Right. $217,000 a year. So you talking tax-free? No. Come on, talk about it.
Add it on.
Come on, add it on now. Tax-free. Tax-free. Come on. If you're watching this video, I need you to type in the chat tax-free. Okay, tax-free. But again, do everybody have $2,000 to put in? Again, I mean, Candy was with Escape. Candy's also a singer-songwriter. I mean, if you know Candy is And shout out to Candy Burris, man. She is a businesswoman's businesswoman. Even the businessman's businesswoman. You know what I'm saying? Because I've followed her story through Real Housewives of Atlanta. Beautiful women on there, man. I love just some nice chocolate ladies. Now I'm married, I'm married, okay, but hey,
you got you a nice chocolate lady too.
Oh my God, I got me an African queen. You know what I'm talking about?
Yes. So he ain't lying. Yeah, some guys say they like them chocolate, but they got a yellow one at home though.
Yeah. Right, So, but beautiful women on there, man, and they all successful running their business, so forth and so on. And I've noticed how Candy moves so much different from the other ladies. And again, information changes the situation. Not that they're all not doing well, because they're all doing well, but just with Candy, again, shout out to just her business acumen and how she operates and moves. And so, like she said, the thing is, so I can put this money, and it's not an investment, guys. She said investment policy. It is not an investment, right? And that's one of the things that a lot of people get into in our industry, right? It's an investment. One, an investment has a risk attached to it. So let's understand that, okay? Like a mutual fund, things that are in the market, stocks are investments because they have a risk attached to it, meaning you can make money or you can lose money, right? In an IUL policy, right, you can either get the gains of the market, right, up to a cap. Let's say the cap, just to keep math simple, is 10%, but then you have policies that have no cap on it, or higher caps, right? But let's just go with the higher caps part, right? So it's either, but let's just say 10%. So with 10%, right? So in that 10%, if the S&P 500, because its index is off the S&P 500, if the S&P 500 is at, let's say, 20% that year, the max you're going to get is 10. But if the S&P 500 drops to, let's say, negative 38%, like it did in 2008 when the housing market and all that stuff crashed, everybody in the IUL was at zero. All their money was locked in. Right, so there is no real risk, and I know people use the Waka Flocka video. I'm gonna put 2-3 million in there, and then they say he went to a Primerica event and he lost all this money. Unfortunately, and I know that. Hey, look, I was once a Primerica, and I know the Primericans want to say, I know the Primericans want to say, well, he lost money in that joint. And all they're going to say is it wasn't structured properly. It wasn't structured properly. Either it wasn't structured properly, and or he did not take the advice of the person setting it up for him and telling him, hey, look, this is how you're supposed to move in this. Yes, you got a lot of money. Yes, you're doing your thing, but this is how you're really supposed to be moving inside. This is how you're supposed to be utilizing this policy and leveraging these different things. We're gonna get into all of that too. So since we on the topic, I mean, how does it work? I know I kind of start talking about the caps and those different things like that, but Sandra, I mean, how does it work? Like when you're talking to your clients and they're inquiring, I heard about this magical thing on Instagram, and it's called a UIL or whatever. Somebody said it to me earlier. I said, man, is that an STD you talking about? Or, I mean, I'm confused.
Right.
You know what I mean? It's an IUL, Index Universal Life. And remember, guys, I was brought up in this industry, man, to really hate these things, right?
Right.
But how does it work? So if you're talking to me, I'm a new client, right? How would you explain to me, like, how does this work and how can it work for me and my family?
But even before that, like he said, this is an index universal life policy. Do not forget the index part, because there are universal life policies that a lot of people had set up before, and now they're hearing about index universal life, and they're like, nah, my mama, my daddy had one, they lost money. This is not the same thing. The index universal life policy is like, it's a Swiss Army knife when it comes down to your life insurance policy. First of all, you have a permanent life insurance policy, which is going to be in place for you forever until you die. So whenever you die, your family is going to get a large amount of benefit because these are not final expense policies. They're not $20,000, $30,000 that's going to pay out. Most of the time, they're going to be 6-digit figures. Okay, so that's the first thing it does. So it protects your income and your assets. The second part that it does is it's like a savings account within the policy because again, it's not an investment; it's your contribution. Part of that money that you're paying for your policy goes into the savings, which that part is mirrored with the index, the stock market, which is normally the S&P 500. You have other options, but we're just going to use that one because that's one of the main ones that they use. So as the money grows, like he said before, you get to partake in that growth. Everything that grows in that cash is locked in. So even if the stock market falls, like you said, this policy, you have the opportunity of maximizing growth and growing your money, but there is no chance, no risk of you ever losing it. So even if the stock market crash, if you have $50,000 in there, that $50,000 is going to stay. And also keep in mind, the younger you get, this the better because time is on your side. So let's say the stock market do crash. The stock market is going to always come back up, based on history and track record. So when it comes back up, your growth starts right back from that 50,000. If you have to use it, you can use it tax-free. And the way that it's used tax-free is you take a loan out on it instead of taking out a withdrawal. That loan, you're taking it out on your own money from your own bank. So people ask, well, are there fees involved? What about the interest? There are small fees involved depending on the carrier that you're using and depending on how it's set up, how much you're taking out. Not going to get into that. But as far as the interest, yeah, there's going to be some interest involved, but you're paying yourself back that interest if you decide to pay it back. If you don't pay it back, stock market doing good, it'll replenish that money within itself at the end of the day. So you can use that money while you're alive, or if you don't use that money when you pass away, if it's structured right, your family can get the money inside the policy plus the death benefit. So it's a win-win situation for everybody involved. And so that's why I have one, and I'm a firm believer in every household should have an IUL, at least one.
Okay, so you said a lot of great things in there. Okay, so based off what you're telling me, so I'm just going to act like the client. Okay,
Right.
So I have a 401k, and I'm putting money into that, and I got a life insurance policy on my job. About 6 times my salary, and so is this, am I gonna get a good death benefit from it? I heard it was expensive. So I mean, how does that work? Like, how much money do I have to put into it?
Well, personally, if you're doing this for generational, like to build wealth, I mean, $100 a month is not going to build wealth. Like, you have to understand that you're funding your own bank. So my minimum, which a lot of agents' minimums are around $250 at minimum. If you're young, that $250 would do you great. The older you are, the more money you want to put into it. That money is only to benefit you. And you have to keep in mind that you're never going to put as much money in that's going to come out. Like, it's the return is always going to be way much greater. There are minimums. Most of these, the minimum that you can get with one company is 25,000. I mean, do I write those? Yeah, but not for wealth building, because $25,000 ain't going to build you no wealth because it's not going to cost you that much. So the average IUL is going to be a 6-figure policy. 6 figures is at least 100,000. So $100,000 bank that you have that can be left to your family or can be paid out to you in increments once you come to retire and stuff. The return is just always greater than what you're putting in. Your 401k, your insurance in your job, all that stuff is not guaranteed. If you lose your job, there goes your insurance, or at least your rates that you have locked in. If that company decides not to continue to provide coverage for your employer, you know, you just have no control over it. 401k, you can have $100,000 in your 401k today. And when you go to take that out, you're not going to have that money because you have to pay fees. You have to pay for somebody for the managing of that money for however long that you've had it. So you can probably bank on cashing out on at least half of what you have in there. And that depends on where tax is going to be by the time you want to use those funds. So I have a lot of people that wants to not contribute to their 401k and put it into the IUL because the IUL is a better deal once I show them and explain to them how it works.
So back up real quick. So you said something very critical there that a lot of people don't really think about. You said where taxes is going to be. So what you're telling me is that taxes right now, let's just say they're at 28, somewhere between 20, 30, 33%, something like that, right? So in the next, you know, I'm a young guy, you know, young guy. Thank the Lord for that. So you're saying in the next 20, 25 years, right? Decided to retire at 60, 65, whatever, that taxes could be in a whole different bracket, that it could be up more, or are you telling me I shouldn't save money in my 401k? Like, what are you saying? I
don't tell people what they shouldn't do. I let people think about it and do what makes sense. Now, and everybody that I talked to about this, I posed this same question. Do you feel like taxes are going to be cheaper, or do you feel like taxes are going to be higher over the next decade?
That's a good question. I guess taxes are going to keep going up, right? Like inflation. Is that how it works?
Pretty much. So I had one lady, you know, she was like, once she retires, she's not going to have that many bills. She don't need that much money or whatever. Mm-hmm. And she got her money in her 401k. And I said, okay, so when you turn 60 or 65, whatever age you want to retire, they're going to take taxes out based on what taxes are then.
Right.
What it is today. You don't get to lock in your tax rate. You know what I'm saying?
Right.
So you don't know how much money you're going to have when you retire. Like, you're just not. You don't get an illustration with your 401k plan. With your IUL, you're going to get an illustration that's based off of what that company does and how things perform. And the thing that is guaranteed is that death benefit and whatever money is gained in that policy. So that's the difference. Your 401k, you're gambling, you're playing around with the government. With your insurance policy, you have a contract with a company, not the government.
Right. And one of the main things there that you also said too is that death benefit, right? Which a lot of people don't also, and again, it's how it's structured, right? You can either structure an IUL to have what's called a level death benefit, right? Some companies call it option A. Some companies just say level death benefit, right? Whereas in, let's say if you're locking in 500,000, it's 500,000, right? And however much you're paying per month or contributing to the IUL will never change until you're about 120, 121. Now, hey, if you plan on being like Moses from the biblical days, then God bless you. You know what I'm saying? I don't know if you're going to live past 120, 121, but with medicine and technology, hey, who knows, right? But basically, your premiums are locked in versus, let's say, a term policy. And I love term too, guys. Look, don't want nobody to try to crucify us on here. Oh, they don't like term. They ought to just push it. Shut up. I like term too.
And we can have a whole episode on term. Every product has its purpose. But tonight we're just talking about IUL.
That's it. Tonight we're talking about the IULs, guys. So with term, and I'm just making this comparison so y'all can just kind of understand it. Term is the most is the cheapest amount paid to get the most amount of death benefit, which is great. You hear a lot of people call it mortgage protection, so forth and so on, right? So I'm gonna get to a whole lesson about that, but pretty much, if you're locking in on, let's say the same thing, 500,000, and let's say it's, I don't know, $70, $80 a month, right? Depending on age, health, and all those different things, right? But let's just say it's $80. After that 30-year term or whatever term of time you have locked in, whether it be 10, 15, 20, 25, 30, some companies even go up to 35. But let's just say 30 years, right? Because mortgage is 30 years, you got it, you just moved to the house. After that 30 years, that $80 is now going to jump up to about $300-400 a month. And then every 2 years, the next 2 years after that, it's going to jump up again. And then every year after that, it's going to keep jumping up, which is called an ART, an annual renewable term. And you can renew this term up until you're 95 years of age, right? So that's great for when you have little kids, you just moved into a home, you're trying to protect a lot of your assets, right? Your greatest assets, which is your home, or you're trying to replace your income should anything happen to you, should the Lord take you home, too soon. Right? IUL is a different strategy because like Sandra B said, we're talking about building a nest egg. We're talking about tax mitigation, right? We're talking about, being able to minimize those taxes, right? Because in an IUL, money builds tax free. Because again, you're paying with net dollars, guys. Yep. This is money that's already been taxed. Okay? So remember, whenever you're paying into an insurance policy, right, it's not coming out of your account. What you pay to your company, that already coming out of your gross, whatever the case may be. That's a whole different thing. You don't even own that policy. And if you need one, please hit me up or your trusted insurance broker today. Inbox us, put in the comments, hey, holla at me, player, and we will holla at you. Okay? All right? So look, IUL, the strategy behind that, we want to build a nest egg so that like Sandra said, okay, taxes may be, we'll say 30% right now. 25 years from now, taxes could be 80%. And I know y'all probably like, oh, bro, you just like capping. No, I ain't capping. What I'm telling you is that 80 years ago, taxes was way higher than what it is now. And obviously the question that Sandra's posing, she's gotten the answer that taxes were much higher or much higher now than they were ever. And wrong. Taxes actually have went down now, but they are possibly on their way back up. So what an IUL does is it's going to give you a tax shelter. So you're going to be able to grow this money tax free and then be able to access the growth of the money tax free, right, through policy loans. Now, people say, well, why would you want to take out a loan of your own money? You're depleting the cash value, right? Because Sandra said you build up money in the cash value. Because some of the money does go towards the premium, and it's for paying insurance and different service fees and things of that nature, right? Just as it is explained in the policy. So when people tell you from these certain companies, right, they say, well, they got all these hidden fees. No. IUL fees are listed, baby. They tell you what it is. Okay, there's a fee for this, fee for this, fee for this, fee for this. Okay, cool. It makes sense, right? Then you're talking about putting it over here for the for your to build up in your cash accumulation account. Right now, again, how we're talking about structuring it is more money is going to go towards the cash accumulation account. We're talking about somewhere around 50-55% is going to be going into this cash accumulation account, or somewhere around those numbers, right? And then someone's got to go to paying insurance. But option B, or maximizing the cash value accumulation, is going to allow your death benefit to grow along with the cash value. So when you pass away, the money that you saved up in the policy also gets paid out with the death benefit. So you can start out with a death benefit that's at $200,000. But as years goes on, right, and let's say you didn't even take out any of the money in the cash value, but now your death benefit is at $500,000. Guess what? When you die, you're going to get $500,000. What these misinformed and miseducated insurance agents will tell you is that you're only going to get one. You're only going to get that. You're only going to get exactly. You're only going to get that. You're only going to get that, and that's how they sound to me. So I'm sorry, guys.
Right. Blah blah.
Exactly. You're
It's a scam.
It's a scam. Don't do it.
But they have no idea of how to set it up because because of their mindset.
Yeah, they only do learn. Exactly. Yeah, either they only do term or they only do a final expense product. Right. Again, guys, I was a hater. And I'm not really a hater. At least I don't think. You know what I mean? We all can hate a little bit sometimes. You know what I'm saying? I mean, look, I'm just being honest. But look, I didn't know I was a hater. I was a hater because I didn't know. I didn't know what I didn't know. And right, and like Sandra said, I had to open my mind, right? And as the quote goes, your mind is like a parachute, right? It only works if you open it. Your mind is like a rubber band. Once it stretches to a certain position, pause no Diddy, you know what I'm saying? It won't go back to where it was. Okay, it won't go back. Right? So what I'm saying is that once I found out how it works, okay, you know what? Okay, so people can put money in it. Okay, so they can grow money. Okay, it grows tax free. They can access the money tax free. I get the gains of the market, but I get downside protection. So they put a cap on it because they say, okay, well, we're willing to allow you to index. Index means it's mirroring the market, right? So if the market, like I said, if the market's at 10%, you're going to get the 10%. Let's say the cap is 10. The market's at 10, you're going to get 10. The market's at 11, you're going to get 10. The market's at 8, you're going to get 8. The market's at 3, you're going to get 3. The market's at 0, you stay there. All your gains are locked in. Think about that. If the person in 2008, right, let's say both of their accounts had $100,000 in there. Okay, they had $100,000 in their 401k. Person B had $100,000 in their IUL. The market went down 40%, guys. It was 38 point something, but let's just say 40% just to keep things easy math. So if it went down 40%, the person with the 401k or the TSP or 403b, whatever it is, had their money in the market. They lost 40% of their money, so they went from 100,000 to now 60,000. 40%. The person with the IUL went nowhere because they had downside protection. The next year, let's say it went up 20%. 120 versus 80%, 80,000. Who's ahead now? It took person A 4 years to get back up to where they were before they lost that money, while person B continued to grow the money. The money was locked in when the market went down. So it's either you gain or you get nothing. That's
never lose.
You never come on. You like it says, never lose its power. What I'm talking about. Never lose. Come on, just like the word of God. It ain't never losing power, baby. It's just like the word of God. Ain't gonna never lose no power. But that's the thing of that. So and what's some other ways that people can use these IUL, Sandra? Like as far as like how do you use it?
Well, how do you use it? Like you mean like what way? Like
what ways? Like if I'm building an IUL, right? Like how can I use this to maximize? Right? You told me that I can build a nest egg. I can build this money tax free. I can access the growth of the money tax free. Like how can I use it to while I'm living? Like how does it benefit me?
Okay. Well, for one, like I said, you have access to the money to use it. And I tell my clients, you don't take this money out to take a trip. You know what I'm saying? I mean, you can, but you want to be smart with it. If I was to take money out from my policy, I would use it for something that's going to generate me more money. I have a lot of people that want to get these because they want to be able to fund their businesses. Businesses generate more income. You want to take your money out to purchase a property to rent out or to sit, something that's going to generate more money. Else you're just pulling money for no reason, which is, I mean, again, you're grown, you have choices, but if you want to be smart about it, that's how you want to use it. You want to use it to utilize in a way that's going to bring you back more money. And then you can put that money back into your bank and let it continue to grow. That's the goal. Another benefit that come with it as far as your living benefits, let's say, okay, when you're max funding it for cash bill, you have a flexibility there in your payments. So, and I use this as an example. One of my clients, they were out of work for almost a whole 11, 12 months because of workman's comp. So they were out of work. They could not work. They could not pay their policy. The money inside that policy paid for their IUL to stay in place for the entire time. Once they started back working, they picked the payments up. Now they had the option of making the minimum payment because again, you're overfunding it. So let's say you can't pay. Let's say they was putting $500 a month, but all their policy was costing them was maybe $130. So if they can't pay the $500, you can just pay the minimum to keep it in place without it lapsing. Also, you can also use your living benefits. If you was to become chronically ill, terminally ill, critically ill, you can use up to 80% of the death benefit without even touching, without having to touch your money that's in the policy. You can use the death benefit while you're alive. You know, I mean, it's so many benefits linked to these policies. That's why I call it's like the Swiss Army knife of the life insurance, because it gives you everything you need in one policy. Another benefit to it is, like I said, the flexibility in the payments. When you do take a loan out on the policy, it doesn't, your money is still going to grow based off of the amount that's supposed to be in there because you took out a loan, not a withdrawal. So let's say you got 50,000 cash value in there, and you take out 10,000. You have 40. You know you got 40 left, but because it's a loan and they're assuming you're going to pay it back, your cash is still going to build off of as if it's 50,000 still in there.
Okay, so basically, so what you're telling me is that the money is building off the principle of what's in the cash value, not off of 10,000 less in your example. You said 50,000. I took out what, 10,000 or 40 or whatever. Okay, got you. Okay.
Yeah, and so then and you said something else. I was about to say something else, but I forgot. But yeah, that's yeah.
So pretty much, it's uninterrupted compounding interest.
Right, it's uninterrupted compound interest. So I was putting it in layman's terms, with the numbers or whatever. So I mean, they really work, y'all. But like I said, it's the secret to it working like this is getting it set up right by speaking with an expert in this, in this industry that's knowledgeable of these products. Somebody that this with Primerica they won't write you one of these because they don't know how to do it.
Somebody said life won't run it either because all they do is senior life, they final expense.
Their final expense, Lincoln Heritage, their final expense. They don't know how to do this stuff. And I mean, hey, no shade. I'm not saying they're not good agents. I'm just saying you want to deal with a broker, someone that's knowledgeable of all products. Oh, this is what I was going to say. The ratio to what you're contributing into the policy versus the death benefit, the way it is that way is so that it's not taxed. So in order for it to be considered a life insurance policy and you can utilize your money and it's going to build tax-free, is because the money that you're putting in to the money that's going to be taken out eventually, that ratio has to stay at a certain amount so that it's not considered a mutual fund, which is an investment, which is taxed on your growth. So everything is put in place specifically to protect you from these taxes, which is a lot of people, you know what I'm saying? What a lot of people trying to do. People with money care about taxes. Broke people probably won't do this because they're not disciplined enough to put money away for this. They rather buy bags and nails and bundles and, stuff like that instead of put money away for their future, which is sad, but that's what's happening.
Yeah, absolutely. Hey, thank you, bro. Out maximizing, baby. Hey, look, man, shout out to my pastor, man, who passed away Saturday night. Pastor Milton Maxwell, who was a father figure to me, spiritual father, mentor in all facets and areas of my life, man. Truly gonna miss him. Definitely maximizing, man. We're gonna make that the hashtag, man, for 2024, man. Maximizing, baby, and give the honor to Pastor, man. So, but yeah, and speaking of maximizing, you want to maximize your financial portfolio,
right?
Did we say that all you should have is an IUL? No, I never said that. Sandra B never said that.
Never.
You know, should you have a mutual fund? Yeah, nothing wrong with having a mutual fund. Hey, should you have if you're working a job, should you have a 401k, a 403b? Yeah, sure. Why not? Look, here's the reality, guys. If somebody would give you the chance to build money into a 401k, a TSP, a 403b, a 457, whatever, by all means take it. They're giving you money to add on to the money that you're building, right?
Right.
Now, all 401ks are not created equal, because you have a 401k that can have a Roth conversion, which Roth IRAs and Roths help you build money tax-free, just like we was talking about with the IUL. Now, again, you got to wait about 5 years, and or 59 and a half, whichever one comes first, right? But but again, Roths are a long-term game. IULs a long-term game. Notice if you listen to what we kept saying, nest egg, right? Wanting to minimize your taxes, right? Later on down the road. So IUL, depending on how you fund it, how most people are going to fund it is built for retirement. Think about it. If Katie Bird said, okay, I'm an entertainer, I'm making all this money, I'm gonna put $2,000 per month into this policy. Right, and I'm not saying that she actually said 2,000. Let me take that back. She didn't say that she was putting $2,000 in the policy. She said, "How much money do I need to put into this policy from this age up to age 40? So then that way I can be able to be paid out when I decide to retire. Then I'm going to make $250,000 per year. So obviously she's putting money away to be able to use the money tax free. So even when she's taking out the $250,000 every year, because these policies have what's called a lifetime income rider. Okay, term does not have that. Final expense does not have that. Only IULs, only IULs and annuities have those things. And I want to say dividend whole life policies. But let's just stick to these two. IULs and annuities have lifetime income riders. So that means as you're building up the money over the years, if you keep this money, you can now use it to help supplement your income in retirement. What is the most thing that people need in retirement?
Money.
Money. Money, 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 money. I mean, they need that money. Come on. Look, I know you be up in that choir talking about. They need that money, baby. You know what I'm saying? Talking about,
yes, we got there rocking.
Right, what do you need?
Yes.
You need the money. You need the money. So this is going to help you. Your future self is going to thank you and say, you know what? I thank you for getting into this vehicle to be able to store money for later on, because now I'm not making any money when I'm older. I'm not working a job. I don't have the same energy. I don't, I'm not doing those same things. But guess what? I got my retirement. I got a tax-free retirement. The name of the game is getting into as many tax-free retirement accounts as you possibly can. Whether you're building a Roth. Right now, Roths have caps on it, right? So you know what? Since we're here, let's talk about the pros and cons, right? So pros. A pro of an IUL is what, Sandra? What's the pro?
Tax-free income.
Tax-free income, right? Tax-free income. A con is you have to qualify for it. So through age and health is the two main things that qualifies you for life insurance. So today you are your most healthiest you will ever be. I don't care if you say, well, nothing happens to me tomorrow. Yeah, I get that. But today you are your most healthiest. And so that can be a con, right? You have to qualify with your health. What's another pro? What's another pro, Sandra?
Living benefits.
Living benefits. So what is living benefits? I've never heard of that. I mean, it sounds foreign. These policies that I got, you ain't got none.
Ain't got none of that, right? A lot of policies. If you ain't had your policy, if you ain't got a new policy in the past few years, you might not have none of that.
Okay. What's that? What is it?
Benefits? Things happen to us before we die. I mean, as we get older, things happen to our body. What a lot of people get diagnosed with stuff like cancer. People have heart attacks and strokes. They get put out of work early. They may be put into a rest home or something. You can utilize this money while you are still alive, to pay your bills, to pay for the medical care, whatever your health insurance may not cover, whatever you need that money for. That's the great thing about it. Which brings us to another pro, liquidity.
Liquidity. So what's liquidity, man? I don't even know how to spell that.
You spell it. You spell it like this. You have access to your cash.
Now, how often do I got access to the cash? Is it like a 401k? You know what I mean?
There is no penalty. If you want to access your money, with a 401k, if you access that money, you take that money out before you're 59 and a half, that you ain't gonna get hardly none of that money in your hand, because you got to take care of the penalties. But with the IULs, depending on how you're funding it, you can have money available to you within the first 30 days. I mean, we don't recommend you take money out, but you never know what might happen. You might have an emergency situation come up. You just dump 10,000 in the IUL and something may have come up. You need to borrow some money. You can have access to that money within 30 days, and you can take that money out with no penalty, because it's your money. You can do what you want to do with it. You don't have to write an essay of, I need this money because of this. It's your money. Like, you are the bank.
You are, come on. Somebody type in the chat, I am the bank. I am the bank. Someone type it. I am the bank.
Okay.
The bank. Now, here's a con. So I'm kind of playing a little devil's advocate here.
Right.
It's not, too many cons, but there's a con. So the con is you don't you get capped off. So yeah, if the market's up, if the market's thriving 3 years in a row at 20%, I'm not getting the full 20% of that. I'm only getting, let's say, if I'm capped at 10, or if I'm capped at 12, or maybe some of them cap at 15, 14, whatever the case. But, again, some of them have uncapped indexing options, and we will get into that at another episode, because that's a whole nother ball game, guys. But, so that's a con. So I'm not getting all the money. Like my people's over here getting that 20%, and I'm only getting capped at 10, man. I don't really like that. So, but what's the pro to that?
Well, I got two pros for you. First of all, where else are you getting 10%?
Not in my bank. I tell you that. I ain't getting it in my bank.
And the other pro to that is, you got to compromise somewhere. We're going to give you a certain amount to match the index when it's up high, but when the index is down, you don't lose anything. Your money is locked in. So if you want your money to be locked in, we got to limit how much we're going to give you when the index is past a certain point. Everywhere else, or with investments, even 401k, people losing money. You can check your 401k 5 years ago. You got X amount. You still put the money into it, but your balance going down. That will not happen with an IUL. Okay. If y'all ain't checking on y'all 401ks, I challenge you to do that, and then call one of us so we can get set up right. Okay.
Yeah, get you set up right. So okay. Another con. I gotta put in all this money. It's expensive. I gotta, pay this, pay that, so, I gotta pay a lot of money.
Okay. And that, I'm not pulling teeth here. If you don't see the value and you don't want to put the money into it, then hey, 20 years later, tell me how you feel about not putting that money into it. I mean, you know what I'm saying? Like, this is for you. And you have to, if you don't value, or if you don't see the benefit of this, then it ain't nothing I can do.
Right. And you know what? And to jump back on the other side of the fence with it, here's the reality, match what you want to match at your job. If they match you 6%, okay, don't go more than that. They match you 3%, don't go no more than that. That's not compounding interest. That's like paying tithes. If I'm paying 10% whatever I made, that's 10%. That's all they're doing. If I pay 10%, they're just matching. Okay, you paid 100. Okay, we're going to give you 100. Cool. So you're getting free money right along with that. But here's the thing, again, like Sandra explained, taxes is what's going to kill you in the end, because there is a money manager who's getting 1% every single year, and you don't see it for 30 years. So they really got you for about 30% over 30 years, and it was 1% every time off of whatever you had that year in that account. And then now you're getting taxed 30, 40, another 30, 40% at that time, or whatever the tax bracket you're going to be in at the time of retirement. You're not going to see all of that money, right? And so,
go ahead.
Go ahead. What you supposed to say?
My problem with that, which should be your problem with that, if this is, your only retirement fund that you're banking on with your 401k or whatever, they're taking a percentage of your money that you ain't ever going to freaking see.
Never.
Like, let's say this year you got 50,000. They're going to take their 1% of that. If you lose half of that next year, they're not going to give you nothing. They're going to take their 1%. You got somebody making money off of your money before you ever see it, and you have no idea how much you're going to see by the time you turn 60 or 65.
That's what they call a thief in the night.
Right.
A thief in the night. A thief in the night, because what they're doing is they swooping in, not like Batman to save you. They swooping in to take your money.
Take your money.
They say, "Oh, we need that 1%." Oh
yes.
Yeah, one. And you might say to yourself, "Well, 1% ain't so bad, but let's add it up over 20, 25, 30, 35, 40 years that you've given this company. That's 30, 40% less on your money over time. So it doesn't appear to be that bad. But again, your 401k is still growing. So the 1% of that is still growing. 1% of 100,000 is less than 1% of $1 million.
Right.
So let's really think about it. In this IUL, again, your money's growing tax deferred. You can access the money tax deferred. There was no penalties, like Sandra said. So if I need to pull out the money for an emergency, a wedding, a college, or buying a bucket for my kids, or some sort of business investment move, or investing, getting in real estate or something like that, guess what? There's no penalty. It don't matter how old I am. I'm not 59 and a half. I got a whole another 19 and a half years before I even get there. But I might need my money now, right? What was it, JG? What? The cash now. I need cash now. Okay.
You don't gotta go to that.
Exactly.
You want your money, you get it, and it can be wired to you within what, a day or two?
Well, maybe not. Okay, wire might be a little different. Yes. Yeah. The check is like maybe 7 to 8 business days, whatever the case.
Yeah. But some of them they can deposit it or wire it to you.
So 59 and a half. Think about that. It's already like a 10% penalty or something like that on it, right?
Right.
Then you're getting taxed on it. So even when you take the money out, you're still getting taxed, because why? That money has never been taxed. So think about all the taxes that's going to hit you when you take that money out. You're getting taxed from them. Then when you buy food, you're getting taxed. Then when you buy shoes, you're getting taxed. Then when you go to another place to buy some deodorant, Walmart, whatever, right? CVS. You getting taxed all around. Yeah, your money got taxed 7 or 5.
You get taxed.
You get taxed. Tax. Everybody getting taxed.
Yes.
Put your money into alert. Shout out to David McKnight. Put your money into alert. Life insurance retirement plan. Because again, you're getting, and let's talk about the cons, because really that's really what it is, right? I'm getting money, right? Let's think about this. Let's say if I'm saving $500 a year, that's $6,000, right? So $500 a month. Sorry. Let's say it again. I said that wrong. $500 a month times 12 is $6,000.
Mm-hmm.
If I'm putting that into a bank that's giving me less than 1% per year, and let's say I did this for 5 years and I passed away, so I had $30,000 in the bank. If I did this in an IUL, so my family would get $30,000, but if I had it in an IUL, let's say now my policy was at $250,000, $300,000. when I pass away, my family will get $330,000. Again, I don't have an illustration.
Oh, actually, I was working up the illustration on a 30-year-old putting $500 a month.
Go ahead, work it. So basically, what I'm saying, guys, is she's gonna show you the illustration. What I'm saying is, the money that I'm saving up, because people say, well, I mean, that's a lot of money to save, and you put into this policy. But again, I'm getting living benefits. I'm getting tax-free growth. I'm getting access to the money tax-free. I'm getting a death benefit. So I'm going to be able to utilize the money while I'm living. I'm going to be able to utilize or access the living benefit riders while I'm living. And ultimately, I die too soon, or whenever I pass away, guess what? My family is going to get more money than I saved up, guys. Let's make it make sense. So if I'm putting $6,000 in per year, but my family's only going to get $30,000 when I pass away, right? And it's subject to probate court, right? Because most of y'all got a living will, and you think wills keep you out of probate court. Probate court is a real thing, baby. And if you ain't got a trust, and we're going to talk about all those different things at another place another time. But what I'm saying is, the money that you put into this IUL, look at all the things that we listed in this conversation that you're going to get out of it. When I die, my family's going to get way more money than I saved up. Way more. When that 401k go, guess what? It's going to get taxed.
And another thing, because I ain't gonna get into the illustration, we don't, because it's gonna be a whole nother probably 20 minutes to try to explain it.
Right.
But another thing, matter of fact, we could drop it in the group or in the comments, you know what I'm saying? Do a little short one later or something like that. But you have to take your 401k out. Let's say you can't leave, let's say, you want to just keep it growing after you're 65 or whatever. You have an age where you have to take the money out or you're going to be penalized. Like, what kind of sense does it make for them to keep trying to penalize you for accessing your money or for letting your money sit for longer? What if you want to work till you're 75 because you just love your job and you're not ready to take your money out, or it has not met where you want it to be? You want to let it sit another 10 years. You can't do that with the 401k. Right. But with your IUL, you can let that sit as long as you want to. They're not going to penalize you because you don't want to use your money, So it's just, I mean, like, we're trying to do pros and cons, but I mean, I think here, the pros just really outweigh the cons here, guys. It's like a no-brainer.
Big time, man. Big time. It really outweighs the cons, guys. Again, you're like, okay, what's going to happen? You're not going to lose the money. Again, man, if you really, as Pastor Hayden always says, man, you have to study real money so you know what counterfeit looks like. A lot of these people are out here just talking a bunch of crap because they're not studying real money. If you study real money, you study what the banks do, BOLO, bank-owned life insurance, or COLI. I said BOLO. BOLI, bank-owned life insurance, COLI, corporate-owned life insurance. If you study what they do, man, insurance companies are the best money managing companies. They're the best. They are the best. You got to look at how they do it. Exactly. You got to look at how they do it. And so what they're doing is these people are utilizing banks and stuff like that. They're utilizing insurance policies because every dollar is protected. That's another con that we didn't bring up. Every dollar that you put in there is protected. Remember, when you're getting these policy loans, it is from the company. God bless you. It is from the company, not your cash value. These things are used as collateral. You die, guess what? Okay, you didn't pay the loan back. We need the money. And it's cool because here's the thing. You used the money while you were living. Isn't that the whole point of life insurance?
You lost it.
Come on, right? It's the whole point of life insurance. I can't use life insurance when I die. I want to use life insurance when I'm living. Hence, i.e. living benefits, terminal, critical, chronic, and a whole host of other different living benefits, right? And then we're talking about cash value, being able to access the money to, like Sarge said, maybe I want to go on a nice vacation. Okay, cool, right? I can take out a little bit of money, right? OPM, I'm using other people's money to make my moves. Okay, cool. So I took out $5,000 for family vacation. All right, cool. Now guess what? I can pay back the money. And here's another pro that we didn't mention. I pay back the loan on my terms. I pay back the loan on my terms.
My terms.
Not on my own terms. Not on 36 months, 20, 24 months, 70 months. No, baby. I pay it on my
Pay
terms.
back when I want to.
I'm gonna pay it when I want to, or if I don't want to pay it back.
Because it's my money and I can do what I want.
Come on. But I tell all my clients, put the money back because it's just like a savings account, right?
Yeah.
If you take money out, you're gonna put the money what? Back. Do the same thing
Okay.
with your policy. This is your bank, right? Because you want to continue to up your borrowing power. Not only that, guess what? If my credit score is trash, like a DJ siren, trash. If it's trash, guess what? It don't matter. The insurance company ain't looking for my credit score. They ain't looking for my FICO. They don't care about none of that. They don't care about payment history. They ain't looking at none of that. As long as my policy is on the books and I'm in good standing, guess what? I can borrow some money from that to be able to up my life, guys. So look, I know we don't went over time, man. Sandra, you got any last remarks for these beautiful people who's been listening to us for this hour and a half, however long we've been up here?
Yes. No, I mean, just I encourage you to ask questions. I mean, you know what I'm saying? Like, take our word for it, but you don't have to take our word for it. Look this stuff up. Do the research. But we are sharing this information with you for free, and we're here to help you if you need us. And this month is Financial Literacy Month.
Yeah.
So, I don't know, Dennis, you got anything going on? Any upcoming events, anything?
Oh yeah. So look, man, I'm gonna be just dropping some content on my page and stuff like that, man. Really help putting you guys on game as far as financial strategies, things that you can do to GGP, right? Shout out to GGP, right? Grow the bag, protect the bag, get the bag, right? But get the bag, grow the bag, protect the bag, GGP. So just different things like that. What you got going on? Anything special? Any conferences, seminars, webinars? What you doing?
Well, I am doing. I have a little speaking engagement coming up this Saturday.
Nice.
But I have a webinar that I'm doing next Sunday evening at 8:00, and it is free. It's limited space. I have a few seats available. It's empowering the next generation of millionaires, and we're going to be talking about the 4 income paths, which is employee, self-employed, business owner, and investor. And we're going to talk about the ways that, you can really maximize your earning potential and which path is the best way to do it. So follow me. Look on my page. I have the flyer up there. Register, share it, because you might not be interested, but somebody might be. Again, it's a free webinar talking about making real money moves, y'all. So
how does somebody get connected? How does somebody get connected with your webinar?
Oh, follow me if you're not watching this. If you're watching this on Facebook, Sandra, you're a trusted insurance broker. I'm not really on YouTube like that, but I'm on TikTok. You're a trusted insurance broker, as the same thing as on IG. Or you can, I can post it in the comments, but I'm there, you guys. Search up Sandra B. It's only one of me.
Nice. So look, guys, man, we got a ton of great things happening, guys. A lot of content will be coming from both of our ends of the social media world. Man, look, if you're not following us, again, my name is Dennis Garland Jr. You see it right there. Never forget the Junior, baby. You know what I'm saying? And that's on all platforms, right? Facebook and Instagram, right? And then, like you said, Sandra B, you're trusted. Is your trusted or you're interested?
Your trusted insurance broker.
Like that. So Sandra B, your trusted insurance life, your trusted insurance broker. There's only one. As she said, there's only one Sandra B. Okay?
Yes.
There's only one. Everybody else is a fake, an imitator, and a duplicate. Imposters. All right, guys. So look, man, again, follow us on YouTube, right, at Drill for Skills.
Yes, subscribe to the page, share it with your friends. Join us on Facebook, Drill for Skills with the S, right? The Facebook group.
Yep, I didn't put the S.
Okay, yeah.
That's all good. Yep.
Oh, no, it's not an S. There you go at the bottom. Y'all can read Drill for Skills. And you'll see us. We got the picture up here in the corner. That's us. If you have any questions, reach out. Our lines are always open. We're always ready to help the people. But this was fun. Great information tonight, as always. And we will see y'all in 2 weeks.
2 weeks. Peace.